Hi, everybody. Thank you very much for joining us, and a very good morning to you all. Welcome to this morning's K3 Hub CPD webinar session, where we'll be discussing cash budgeting and short-term finance planning. For those who haven't virtually met me before, my name is Marie Wadeson, and I'm a Managing Director at Quantuma. And on behalf of our parent company, the K3 Capital Group, I lead the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. By way of background, K3 Hub launched in the spring of 2021, and we're proud to have over 2,800 members. K3 Hub offers a range of CPD and training sessions, not dissimilar to today's event, and referral fees for certain types of work referred into our group. Just for those that aren't familiar with the group, our group offers a wide range of niche advisory services, which include restructuring, corporate finance and business sales, forensic accounting, R&D tax credits, and marketing services for professional services firms. A few bits of housekeeping just before we get underway today. So as you will have noticed as you joined the webinar this morning, we are recording. The webinar will be placed onto the K3 Hub and Quantuma websites next week. So if you want to refer back, that's where you can go to. Q&A function is open, so do feel free to ask questions as we go along. Preference is if you could use Q&A to ask your questions rather than the chat, just so that we make sure we're all looking in one place for those questions. That would be extremely helpful. We're anticipating we will have quite a lot of questions today, and there's a potential we might not get through all of them, in which case, apologies. We know it's a long session today, and so we will be taking a couple of comfort breaks. They'll be 10 minutes each and sort of there or thereabouts on the hour. I'm reliably informed that today's session falls neatly into three separate sessions, or three separate sort of or distinct areas. So that's when the breaks will take place. Anyway, on to today's webinar. So I'm delighted to introduce our speaker today, Karen Spate. Now, Karen is brand new to us here at the K3 Hub. We've got a lot of people joining us today, so no pressure, Karen. Just a bit on Karen's background. So Karen has more than 25 years experience in working in professional services, both as a solicitor and chartered tax advisor. She has her own business, providing education services for tax professionals, and she's also the author and co-author of a number of books on NIC and income tax, which are published annually by Claritax. In her session today, Karen will broadly cover the reasons why a business might need to hold cash, identifying the operating and cash cycles, preparing a cash budget, creating an appropriate short-term financial policy, and ways to improve cash management. Just before I sign off and hand over to Karen, a quick note on some of the forthcoming K3 Hub events that will be running between now and July. We'll be covering subjects such as accounting issues, tax obligations for business owners, the tax opportunities that come with expanding overseas, and the people aspects of M&A. You'll find further details and registration links on the K3 Hub and Quantuma website shortly. And of course, in due course, invites will appear in your inbox, so do look out for those and join us if you can do. That's all from me today, so I hope you enjoyed today's session. Wishing you a great weekend when it arrives. And Karen, over to you.
Thank you, Marie. So welcome everyone to what is a sort of a fairly dull but very shiny morning up here in Leeds. As we said, today is all about cash budgeting and short-term finance. Yeah, let's just think about what we might be doing today. Let me start on the slides. So our objective today is really, as Marie said, to consider the importance of cash planning to a business. And really I want to look at the issues that are involved when we are looking at cash budgets and how we might use those cash budgets to optimize our cash management and also to determine short-term financial strategies. We've got 3 hours. I always love 3-hour sessions because that means we can sort of get past what I would say the article level of cash planning and sort of dive quite deep. So this session is quite detailed in some parts. I will take some breaks, as Marie says, as we go along. It is ultimately your session, so if you have got any questions, if you do pop them into the Q&A, we've got quite a few people here today, so I might not get to them straight away, but I promise you that I will deal with them all in the course of the morning. So it's your session. I do want you to get out of it as much as you possibly can. Okay, so our agenda, I'm going to talk a little bit about the case for budgeting, and how that sort of fits in with movements like beyond budgeting. And then why have I picked cash today? You know, it's like there's numerous budgets out there. Why is it cash that I want to focus on? I've got a good sort of reason for that. How we actually would create a cash budget. As I said, this is not an hour session, it's a 3-hour session. So we are going to sort of get down and dirty and tight and sort of work out how we can go about setting up a cash budget. And of course, for you, when you're advising your clients, it's not just your business at all, but the sort of issues that your client should be thinking about if they are trying to budget with cash. I then want to how we would actually use the cash budget for business planning. It is part of the usual sort of business planning that we would do, but I find from both my own experience in running businesses and also those of my clients that actually staying with cash can give you a real sort of oversight as to flows, working capital management, and how ultimately whether you should make it, what you should take into account, and whether you should move forward. So I think it's quite a good thing to think about today. Then once we've got into that, I want to look about how we might control our resource to actually improve our cash position. And then I want to finish off with how we generate short-term finance. Those last 2 bullet points are interlinked, because clearly as we control resources, we are actually generating our own type of internal short-term finance, but also want to have a little look at the external finance that is there. So hopefully that's the kind of what you were expecting. Let's start then looking at budgets. So why do we need budgets at all? Well, it's very tempting on a day-to-day basis to just focus on the problems that we come across and be quite reactive in terms of addressing issues when we are running a business. And firefighting seems to be the norm at the moment. But fundamentally, if we can build in time for planning, particularly for the future, then we are nearer to getting our business objectives and meeting those sort of the targets that we have. And really that's around well, I've put 2 bullet points there: maximizing owner value and making a positive difference. And if you sort of old school, you may remember that the sole reason for running a business advocated in sort of the 70s and 80s was to create shareholder value, to maximize owner value. Over time, and particularly as we've moved into this sort of century, businesses do exist for other purposes, might actually want to make a positive difference in the world. So I've put that down. Whatever your business objectives are, though, planning for the future is quite essential. But if we have our planning, the best plans in the world are great. But actually, once we've done the plan, we do need to control our resources. So the resources that we've acknowledged that we need and we want to have in the plan, it's all well and good, but a plan is just a piece of paper unless we put it into action. And in putting it into action, we will need to control the resources that we deploy in order to avoid inefficiency. So therefore, the role of a budget is not just about planning, but is also about controlling our business going through the things. So that's really why we need a budget, is to deal with the planning and control of our resources. As I say, quite a lot of you are accountants on today, so I'm guessing that I've not said anything there that you have not come across already. But before we go into budgeting, just let's make sure that we're all on the same page about what we mean when we say a budget. And there's a technical definition that I've managed to drag out. It is a formal and quantitative and authoritative statement which details the objective of the business and sets out expectations regarding the allocation and consumption of resources. So there's quite a lot to that, but we can see that if we can do it properly, it should be complete. And therefore, the role of the budget, there's multiple sort of roles that a budget takes place, that a budget focuses on. It's not just a technical exercise. I know myself that in some businesses that I've worked with, there are a number of, sometimes it's an annual budget setting thing. It's not meant to be a technical exercise if you are working in an environment where it is just a technical exercise, then you're kind of like losing an opportunity, because it does force managers to look to the future and commit plans to paper. Sorry, I've got someone who says they've got an echo. It's unusual for me to have that. I'll just move my mic a little bit to see if I can change that. So but overall, it's an important means of influencing behaviour. So again, a few reasons there that I've just put down on the slides. I've done quite comprehensive slides just so you've got them as a takeaway. So there's an allocation of resources. We've talked about that already, but we can use the budget as a platform for communicating both externally and internally with our employees and with those who are responsible for delivering on the business objectives. So we can use the budget to coordinate activities between departments. We can also use it then as our basis for authorising expenditure. Somebody says, can we spend this amount of money on the and buy this? You say, is it in the budget? Yes. Okay, it's authorized. It's not necessarily the best thing to do, but it is something that the budgets are used for. We could also have them as a basis of performance appraisal and also to motivate staff. I will come on to that a little bit separately later on this morning. And then, of course, there's the external credibility when you're dealing and speaking to banks and other suppliers and other creditors. Then the fact that you have budgets all prepared and there, and that you've got the numbers, can build external credibility. Okay, so why the cash budget then? Well, there's lots of different types of budgets. For example, I've said sales, capital expenditure, where we might have costing budgets, but they are all interrelated. But cash budgets enable us to see how the planned events are expected to affect our cash balance and also help us identify periods of surplus and deficit. And the thing I like about cash balances is that they, as well as being able to compare with our actual cash flows, it helps us take corrective action. They fit quite well with the small business. So I'm sure that you have a wide sort of variety of clients, but for even the smallest business can benefit from and use a cash budget. And we have I'm thinking really of the life cycle of the business that the K3 Hub sort of focuses on. The cash budget lends itself very much to the small business that's looking to expand and is just on sort of a startup. So we said that. But of course, there are limitations. Let me just see what we've got in terms of the thing. Okay. Sorry, we're all with the slides. Hopefully the sound is sorting itself out. It seems all clear from my end, but so if you've got a problem, it's the old thing of log out and log back in again. But do let me know if you've got any continuing issues. So the budgets are only as good. They are created by people. So the budgets can be inaccurate. They're based on a lot of assumptions which can change, and that is particularly one of the issues that we have in the very fast moving environment that we find ourselves in at the moment. So we can set a budget based on so a cost, and then the cost could change next day. So they can be inaccurate. They therefore need to be reviewed and adjusted on a regular basis. And that's another thing that's in favour of the cash budget, is that if we have something that's relatively straightforward, we can keep sort of monitoring that. But yes, so inaccuracy is our limitations. Manipulation is another one that we see, where you've got managers who are going to be appraised. As I mentioned before, you might use it as a basis for performance appraisal. If you do use the budget for performance appraisal, but it's the managers that are being appraised on it, then they are very likely, or possibly may, set lower objectives just so that they manage expectations or can more easily meet those targets. And that is in no way saying that the people who prepare budgets lack in integrity, but no, it's just around the sort of the stretch position. Can be quite tricky. And equally, if we do sort of overstretch them because we're using them to push our performance of our employees, and we are using them to sort of judge them against bonuses, we also risk inaccuracy as well. We also risk people sort of turning off from them in terms of doing what they do, because if you just set really hard budgets, people just say, oh, they're meaningless to me, and then don't really adhere to them. So yes, whilst it might be tempting to use budgets for the basis of performance appraisal, you do risk damaging the integrity of the budget unless you unless you think about that and build that in. The one thing that you do see this particularly with sort of public bodies, I think I've seen it most, is excessive spending. If you have a use it or lose it mentality in terms of budgets, then that can lead to unnecessary expenditure, which in turn damages profit. So are you an example, I'm not going to quote, I'm not going to say any names, but they have a particular budget around training. And as it came every year, they would spend that budget on training so that they had the budget for training in the following year, and to the point where people were being trained for things that they would never do in the business or not. So yes, they were all over budgets. Yes, they were proud of the fact they set budgets for training, but actually they hadn't given the managers the power to say to save money, but then have it reinstated the following year. So that actually happens quite a lot. And then we've got conflicts again between departments. If we focus on departmental budgeting, then we risk damaging overall efficiency. You can get to a situation where the person who is the most focused in on budgets and fights for their funds, they actually end up getting an unequal allocation. It's a higher performing department. They seem to be able to demand more funding. They can argue it better, the case for funding, so they get the money. So it's very easy as a manager or an owner above that to just sort of sit down with the budget guys. Actually, you can see that might mean that we're not using our resources appropriately. So I guess as well, the overemphasis on financial outcomes can also ignore the qualitative elements that we get, like quality and customer service, and be aware really of. Be wary of that, I think, because often we see an argument against budgets because we think because of this quality, then the fact that they do not ignore the they do ignore the non-financial elements, and that in itself can be damaging to the business. So let me actually just go back on that. So overall, therefore, we could be in a situation where the budget, we can set off with the best will in the world, create our budgets, help them control our resources. But actually, if we are slavishly linked to them, we could fall into one of these categories around. So we just I'm a big fan of budgets, and I'm a lawyer by background, so that's like a huge conversion for me. But we just need to be mindful of these and how actually they can be damaging to behaviours. And I think when we are dealing with clients and we're talking about budgets, we're talking about where they take the business, we need to just watch to see if they are sort of self-damaging through exhibiting some of these behaviours. Okay, sorry. Okay, so I've said that we really are thinking about budgeting. You may have heard about the Beyond budgeting initiative that exists. There are a number of companies and businesses out there that just move away from budgeting altogether, and that has a certain amount of traction. But fundamentally in this sort of cash-strapped society, we're not really in that growth phase and that free-for-all where there's a lot of money flying around. So probably it has become less popular over the last few years. So cash then. So let's proceed. Whatever your personal views are about budgeting, let's proceed on the basis today that it's a good thing, that it has limitations, but actually we're going to be watching for those behaviours as we work with ourselves and our own businesses and our clients to make sure that that the downside of that is minimised. Cash. If I've seen one article that says cash is king, then I've seen a million. It's a very, it's a bit of a trope really in terms of how it's bandied around. I'm going to adapt it as well. The one that is the quote that I've put on this slide is equally as common. So I'm not claiming that I've done anything special, but it's the one that I like because we've got this idea: sales revenue is vanity. We all know how pleased we get when we generate sales. The profit is the sanity, the thing that gives us the comfort that we're actually doing things right. But the cash is the reality of our business. I'm sure I don't need to tell you that there is a big difference between cash and profit. We can have a very sort of profitable business, but we could still be stuck for cash. And we'll come on to see why that's a problem for us. And I've just really put a slide there together. I'm not going to work through everything, but just to say that there's certain things that help our profit that actually have no impact whatsoever on sort of cash. So if we repay our borrowings, for example, that will have no effect on profit or overall on our accounts, but it will obviously suppress our cash because we'll need the cash to repay the borrowings. Equally, we can improve our cash by if our credit customer pays us quicker, but that doesn't alter our profit because we will have still they'll just switch from creditors to cash at bank. And equally, again, if we issue new shares for cash, that doesn't alter our profit either, but it does give us obviously gives us a cash boost. So we've got to be quite clear that when we're talking about profit, which is important for building shareholder value, but also we are not talking about cash. They are two completely different things. And today we're really focusing on cash. Our reason for focusing on cash is because we need it on a day-to-day basis. That's why it's the reality. A company or any kind of firm needs a certain amount of cash to get through the day, and that is to fulfill their debt obligations, to buy inventory, to pay our employees. I did actually for a very short time when I first completed my training, work for a small law firm that used to be very, very focused on getting all its cash together each month so that it could actually pay all of its employees. Okay. Okay. So I'm still getting some sound. So we'll also we want to take advantage of commercial opportunities as they come along. So it's good to have some ready finance. Also, we have by the same. That's exactly the same as sort of really taking advantage of commercial opportunities. Sometimes they're not opportunities. Sometimes just costs come up that are unexpected and that we need to meet. We also need to protect against uncertainty in our outlays. I think before this session, somebody had sent a question in talking about, how do we deal with change very quickly when we're dealing with sort of budgeting and the uncertainties that we have, and certainly the cash buffer can really help us weather the storm in sort of external situations. Also, we've got to gives confidence again. If we are cash rich, then we know long-term lenders and investors can have a little bit of confidence that you are able to generate the working capital in order to keep going. But in terms of how much cash then we need is almost how long is a piece of string. If we accept the premise that we need cash, then we want to make sure that we don't have too much cash. Otherwise, we are wasting investment opportunity. So a lot of it does depend on the circumstances. So I'm just, again, thinking of some that are there. We've got the nature of the business. So for example, we might have a seasonality around it. My husband designs and builds, has his own business designing and building custom skateboards, which is very interesting, but is very seasonal. And he tries to ride that out by selling overseas to the US, where they have better weather than we have during the winter months. But really, it's cash. The cash that comes in does have a seasonal element to it. Obviously, we have at the moment an opportunity cost of holding cash, because there are investments that we can do with high interest rates that give us a higher return, or we might be tempted to reduce borrowing to effectively reduce the cost of finance. So the reality is that if we have too much cash, then we effectively, that is a cost to us in the business. Inflation, if we keep a lot of cash with the inflation, it's steadied out now, but we lose purchasing power as inflation and costs increase. So again, a big sitting on a pile of cash won't necessarily will help us there. If we have some near liquid assets, then that would help us be more comfortable with a smaller cash buffer. If we've got marketable securities or inventories that we can turn over really quickly, does mean that we've got less cash that is needed. Obviously, if you were a land-rich business, the lack of liquid assets might make you want to feel more comfortable with cash. Again, borrowing, we've talked about the cost of borrowing, but availability, we might not be able to get our hands on borrowing. And if we don't have the right lines of credit, then we're going to need a bigger cash buffer than we otherwise would have done. And of course, with the economic conditions, when everybody else feels it tough, everybody's trying to slow down payments. We'll come on to that later on and how that affects our cash deployment specifically. But if everybody's delaying payment, we need to hold more cash so that we are able to meet all our debt obligations. And of course, our relationships with our suppliers. If we're in a position where we've been able to build up trade accounts, then we would need possibly less cash than we would if we were just a startup. So all fairly obvious when you sit there and think about it. It's all common sense. But again, it's all things that we need to address when we are making sort of this decision. Okay, so we've got to this position. Let me just take our timing where, maybe I've convinced you that we might, there's a role for budgeting. I don't think it's a hard sell to say, we need to make sure we have the correct amount of cash. Before I go on to actually how we would go about doing a cash budget, which is the meat of really today's session, I do want to make the point about having too much cash. If you have too much cash and it's not for use in the business, you can jeopardize your business property relief and for IHT purposes. So HMRC tend to allow business property relief, except where there's a huge amount of cash that's not obviously for the purposes of the business. If you've got spare cash and you will come on and see later, and you do investments that are not to do with the business, so you decide that you're going to get some sort of marketable security just to generate some return, then that can not only jeopardizes the business property relief, but if it goes over a certain level, it can also mess up your qualifying for business asset disposal relief and gift relief for CGT purposes. So whilst we need cash, we also need to be not have too much cash and non-business assets. As I say, we normally can get away with cash in the wider sense because it's quite hard for HMRC to argue that you don't need the cash for the business. But once you start investing that cash in non-business assets, then you thought pretty much you are saying you have got non-business assets within your organisation. Okay, so we're going to be preparing a cash budget. Don't really want to just talk about it at an academic level. Let's try and bring it to life a little bit. I'm going to go with Lazy J Bakery Limited. I'm pretty sure well, I know that that's completely made up, not meant to be representative of any real business at all. I've got it's a company. It's owned 50-50 by a husband and wife team, J and K. They split down their responsibilities. Both of them work in the business. J supervises the bakery and deals with the marketing and any of the non-financial management issues that come up. So the health and safety, for example, hygiene certificates, purchasing, but the actual sort of collection. Supply lines. K is responsible for the front of house and also deals with the financial management and compliance. And her background is really in cake design and cake decorating, which is why they started Lazy J Bakery in the first place. They have 2 employees, Holly and Dave, and they are both part-time bakers and servers. And this business, it was established in 2021 and the core business is this retail bakery. They do have a sideline of the celebration cakes to order. I'm going to say that's as I said, that's how they decided to go into the bakery in the first place, because Kay made cakes at for a very kind of level, hobby level. And they've moved it into this business. They do operate from one site that is rented, and it's in a suburb of Leeds. They do all their baking in-house on site. And the retail outlet is effectively their lifeblood of their business. They have a very limited online presence. So again, I've picked a small business. I've designed it so that we can think about the issues that face a small business that is actually doing okay, but doesn't know where to go next. And we've got sort of very personal investment in that it's a husband and wife team that have effectively launched their business off the back of a hobby. And again, we think about how they would go around preparing a cash budget and what use that would have for them. So in terms of preparing a cash budget, there is no set format. It is an internal document, so it actually does need to be useful to managers. We need to set it up in a way that we can read it and it has useful information in it. Otherwise, there's no point in doing it at all. They're typically broken down into set periods. For example, a month or a quarter. I have to say that probably whether it's a month or a quarter depends on what we do in the cash budget for. Anything that's like longer than a year, if we're doing a year in total, it's will need massive adjustments used to bear in mind the speed. So we typically do it to cover a year or 6 months. And if it's a 6 months, it'll be broken down in a month. If it's a year, it will be broken down into quarters. I actually think for small businesses, you kind of need it on a month by month basis. Everything is happening so quickly. Now, because our focus is on cash, we're going to be excluding credit sales. And in terms of credit sales for retail businesses, this would include credit cards, but not debit cards, because debit cards you are paid straight away. So credit sales are excluded because it's all about cash and we have that delay. Similarly, expenses that we have in our accounts, such as depreciation, are not recognised. So basically, when we're deciding what's going in our cash budget, we are thinking about the exchange of cash actually taking place. And we're really looking for surpluses and or deficits as we go through each of the periods. So we want to see that we're ahead of the game or where we're going to fall behind so that we can take corrective action. So we need a running cash balance to be able to work with that. Okay, so this would be sort of a standard format. Again, if you've accountancy trained, you probably recognize this a little bit, but we would put our cash, all our receipts, which would be our cash sales, but also the payment of our debtors or trade receivables. So you might expect that in any period, credit sales from previous periods will eventually be paid off and those turn into cash. So we do need to recognize those, but we won't be recognizing them as the debt arises. We'll be recognizing them as the cash comes in. We then need to recognize our payments out. And I want to talk a little bit about what those kind of costs are included, because I think where people go wrong with cash budgets is in identifying the payments that they need to include. But I've just put a few, they're just examples: materials, salaries, other costs, all set out within our payments. And then we pretty much have this, oops, we don't want to go on to there yet. We want to look at our total receipts less our payments, gives us this sort of surplus, or so this line, I don't click it because it'll move on. Does the so the line total receipts less payments gives us an idea of whether in that particular period we are generating a cash surplus or a cash deficit. We then add on our opening balance, which is literally just our closing balance from the previous period, and that will either be that will either increase our cash or decrease it, depending on whether we were in a surplus or deficit last month. And that gives us our closing balance. So literally the closing balance for period 1 will be the opening balance for period 2. And what you would hope is that you would keep this fairly static, because if your closing balance stays fairly static and positive, then as long as it's enough for you to sort of do, and that comes into how much cash do we need, then we're happy and we're stable. If it's going down, we need to make sure that that's a temporary thing. If it's going up, we might actually be getting, we might be in a position where we're generating too much cash, heaven forbid, and so we might want to think about expansion. Might be a time when small firms and small companies can start paying themselves, but if it's, as I say, if any of it is in deficit, then we're okay. if we've done our budget, as long as we can see it rising up later on. So we'll talk about cash control later on, but this is what the cash budget balance can tell us. So talking about this example, I put this up because it makes a change from seeing graphs and tables, which we'll be seeing a lot of, but it's also, it's not meant to be flippant. It's actually about remembering what we're doing this for. So as we get talking to clients, when we start, we've done the case for budgeting, we've got them all bought in, we've talked about the dangers of it and becoming obsessed, but fundamentally we've got to remember why people do this. So in my Lazy J bakery, we've got J and K doing this because they have a passion about cakes and what they are doing. So we need to keep a sight of that. So it's just a reminder that people do business because it's something that they love doing, and we don't want to take all the fun, the joy, the creativity out of it when we're looking at budgets. So if we use this example, we'll do this example and then we'll think about having a break. I've built a budgeted income statement for the Lazy J bakery, kept it at a fairly low level. It is a small business. And we can see that for these are all totally made up. We've got the next 6 months, the income statement that they think they're going to be generating sales between 22,000 and 30,000 a month. So pretty successful for a small bakery. The materials is the bulk of their cost, obviously their ingredients, and they've got limited sort of salaries because they've only got 2 part-time employees. Utilities costs a lot for this business, the running of the ovens and the electricity. It is a fair cost. We've got some depreciation in there because they do have some a motor vehicle, and I've just put other costs because it's there's bound to be ones, and I want it to look a little bit more robust. So it is a profitable business, not making a huge amount per month, but they are running at a positive level. We see the due take payments by credit card, but these only represent 10% of the sales and they are settled 1 month later. We're told that the sales revenue in December was 30,000 and the cost of materials was 11,000. As I say, we need to look backwards in order to create our opening balance. We do buy our materials on 1 month's credit. We keep our inventories at a steady level. We'll come on to that in the latter part of this morning about inventory levels. And we pay our utilities quarterly in arrears in March and June. Other costs are paid as they're incurred. And I've told us that cash at the beginning of January is 4,000. So as I say, I've completely made this up, but tried to make it representative of a small retail business. Hopefully we would look out for these elements of whatever business we were looking at and whatever we were sort of thinking of. Now that's our income statement. Profit seems all fine, but we need to really work out what this all means in terms of cash. So when we move that into the cash budget, we do see actually it's a fairly, it's almost a better story because of the way that this business is structured. So we've got the cash. I've put some notes on the sort of the next page, but the cash here is identified as it goes. It includes our cash and our debit sales. From our debtors, we are taking, remember we said 10% of the sales were credit sales. So let me just go back to the last one. If you see, so when we look at January, 10% of those sales, so 2,200 would be credit. We can't recognize that in January. We can only recognize that in February. However, in January, we can add in the 10% of the sales revenue from December, which was the sales revenue was 30,000, and so our 10% is 3,000. So we can actually, so in January, we would have 90% of the sales plus 10% of December's sales that have now been paid off for us. So that's why we get to the receipts of being 22,800. In terms of the payments out, so materials, again, we're buying those on credit. So we're going to be recognising in January the materials that we purchased in December. In February, we'll be looking at the materials that we purchased in January and so on. So effectively, our cash budget is like the exchange of cash. Salaries, as we said, and the other costs we pay as we go, so we just recognise them in the year they are, in the month they arise. Utilities, we pay only in March and June in arrears, so we have those two outgoings. This gives us our total receipts less payments is our sort of net cash position for each period. Then we've got our opening balance, because we would either have some cash to bring forward, or we would have a deficit to bring forward, and we build those up. And we can see that the cash here is steadily improving, to the point that I'm thinking, why by the time I get to June, there's too much cash in this business. They don't really need, sort of with those revenues and the sale that's going, they don't really need that level. And I've done that deliberately because I want to talk about sort of how we would use this for expansion. So the credit sales, those are just the notes. So we've already gone through those, so I don't need to go through them again, other than remember other costs, non-cash costs, which we had in the income statement, the depreciation, we took that out. That's the only thing. I say that's more for your benefit when you're looking at the slides at a later date. So what are my sort of observations on that cash budget? I think I've seen most of them. Given the size of the business, there does seem to be a fairly large cash balance, which towards the end of 6 months is increasing. So we can breathe sort of a sigh of relief. But we could these various things we could do. We could just chill. We might want to put some cash into an income yielding deposit. We might want to increase our investment in fixed assets. We might want to increase our investment in current assets. We might want to actually just pay some of that out to J and K. And we might want to repay borrowings, if any. I've not got that in my sort of budgeted income statement. It might be in the other costs, but really we've got all these things that we can do. And it's a nice position to be in. I'm guessing there's not that many businesses out there that are in that position at the moment. But we've got, before we all sort of get giddy and go and start doing buying everything, it's like, well, hey, we've got to think it is only covering a 6-month period, as we see things change really quickly. So that might mean that we need to look a little bit further before we sort of burn all the cash. So if we're in January, should we really be spending straight away? And as I've mentioned already, before we start getting into non-business assets, investments, we need to think about the impact that has on us for tax relief. And we've not seen the balance sheet here for Lazy J Bakery. It doesn't sound to me, if they have a retail shop, we've got a vehicle, there's not a huge amount of business assets in there. So a non-business asset could really skew things pretty quickly. Okay, so right, okay, so I'm just checking the chat box. Seems to be a lot of chats, but it seems to be all sort of technical things. So we've done our cash budget, and you might say, well, that's just told us that we're okay. But actually, it's made us. If Lazy J were my client, I'd be starting to challenge them around what they were wanting to do next, without obviously sort of putting themselves in an overstretch position. Okay, so we want to now really think about the kind of decisions that those that they would make on the back of that cash budget. So I think that's probably a good time for a short break. So if we just make it a sort of 10 to 10. So if we come back at 10, just gives everybody a chance to sort of grab a cup of coffee so we can, before we dive down into the detail. Get back into it. So before we had the quick break, we had actually prepared a very quick cash budget for our Lazy J bakery, and as a result of that we thought actually our cash position is quite strong, recognizing the limitations of the fact that we've only done it for 6 months. So we should actually think not jump too quickly, and also bearing in mind that we don't want to keep a massive cash reserve that might, or invest in something that might jeopardize our tax position. So against that, I want to really now explore how we might use that in our business to make decisions. And with Lazy J Bakery, we've actually got a good cash position. Later on in the morning, I want to look at the situation where we have a less good outcome because we have as many clients as with in difficulties as we do with people who are growing. So Lazy J have thought about it, and they've decided that they have an idea around expanding their business. And they're thinking that they could actually introduce a delivery service of sandwiches to local businesses. Now, they have invested £1,000 in some market research, which shows that the realistic sales would be 400 sandwiches a month in January and February, 1,200 in March and each of March and April, and then 2,000 per month after that. Each sandwich will sell for £5. Now, what you'll notice in my presentation today is that I am skirting around, or rather jumping over, the issue of detailed costing and pricing. And that's because it's a 3-hour session on its own. Maybe these, if this goes down well, I may come back and do a pricing session for you. But today we've not got the full day. We've only got 3 hours. So we're just going to say that we're going for a selling price of £5, and we are comfortable with that as being an appropriate price. The company does have a van, and it's not currently used. There is an offer outstanding to buy the van at £8,000, but they've not really accepted it. And if they go ahead with this expansion idea, then they could use it for the new service. It would need to be sign written, I believe, and that would cost £1,000. Pretty cheap for sign writing, but I'm a lawyer by background, so I kind of like round numbers. And then we're told that the sign writing will not affect the van's value either way. We would need to recruit a driver at a cost of £15 per hour, and that's a sort of an integrated cost. Just so obviously when we are looking at new employees, there's lots of costs involved. I'll chat about that shortly when we look at what costs we include. But we are expecting that the hours will be 25 hours per week. Jay is going to take on the marketing as part of sort of his current role, and Dave is going to process the orders, and they don't really expect that either of them will need to increase their hours very much. So we're going to utilize both Dave and Jay. They've got spare capacity. We're going to be using the existing space and the machinery, the ovens, and therefore we think the utility costs are not going to be affected. They actually have over 10,000 cardboard boxes stacked in the back that they thought could be used, but it turns out that they haven't been able to use it today. They are £400, but they are regarded as obsolete, so they have no current value. But if they do go down this lunch delivery, then they could be utilised. They obviously will need more ingredients for each of the sandwiches that they provide, and they will replace these as they go. They've worked out that the average ingredients are going to cost £2 per sandwich. Again, I'm jumping over the cost in there. Holly, the other part-time employee, currently is part of the making the cakes to order. They think they're going to redeploy her, and as a result of which she will be able to do 12 less cakes per month. And these are currently charged at £100 each, with a profit on each cake of £60. So we've got all the information that we need to collect to enable us to work out how this expansion idea will work for us in terms of cash. It's nowhere near as straightforward as saying, oh, we sell it for £5 and the ingredients cost £2. So we're going to make £3 for everyone we sell. And that means we're going to be making £6,000 once we are selling the 2,000 a month. I mean, it is as simple as that, but obviously that going into it with that idea doesn't really talk about us in terms of the impact on the rest of the business. So in order to make a business decision, any business decision, not just anything that's based on like a cash budget, we always have to weigh up our relevant benefits versus our relevant costs and associated risks. So this is sort of a fairly, it's almost as lacking in innovation as my quote on cash at the beginning. But the relevant benefits, what do I mean by that when we're talking about it? Well, those are the resulting outcomes which help the business achieve its objectives. So whatever its objectives is, the benefit is an outcome which actually helps us with that. A relevant cost is a sacrifice of our resource to achieve our objectives. So if we think about our cost is always in terms of depletion of resources, you know, I've got £1,000, I could go buy a handbag, or I could keep it and invest it, or I could give it to charity. All those deplete my resource, except maybe the buying of a handbag, because if I was to buy it and it was to go up in value, you never know, then you are actually swapping just cash for a different type of resource. So to think about a cost itself can be a sacrifice, or it can in its entirety, or it can have a bring something into the business as well. And the associated risks. Obviously, if something's got huge benefits, but it's got huge risks attached, then that's why I've got a scale. Those two balance each other off. So when we are looking at this kind of investment, we want to be thinking about the relevant costs. In other words, the downside of our scale. Our benefits, I guess, would be articulated in terms of our additional profit. Remember our stated objectives at the beginning was to build shareholder value, and also maybe make the world a better place. But if we're just going to stick with the traditional thing of making shareholder value, the question we've got to say is actually how will the sandwich delivery business enhance value? And it will if we sell more, make more profit. Ultimately, if that turns into cash, that could be good, but that might actually be outweighed by the relevant costs. And it's not always easy to determine what the costs are going to be. And we do have to think about, we've got our historic costs, which is our acquisition costs of our assets that we use, versus our opportunity cost, which is the benefits that we might actually forego as a result of investing in this particular expansion idea. So for example, we've already seen that we are going to be selling less cakes as a result of doing this sandwich delivery business. The opportunity cost of selling the cakes is a benefit foregone. And we need to make sure that we don't give up so many benefits that effectively the benefit that we generate through expansion is eaten up by other opportunity costs. We've got our outlay costs, so there will be costs of things we have to buy in order to deliver this new service. So ingredients, for example, is definitely something we've got to outlay. We've got to sign right the van. We've got to get a new employee. Sunk costs are the costs that we've already invested, and they are totally irrelevant. And sunk costs a very dangerous thing when we are looking at investments, because we get really focused in on them, like stupidly so. And I'll come back onto that in a moment. But also there are what we call committed costs. So these are costs that we will need to pay regardless of whether we do it or not. So our utilities bill, for example, we are committed to paying that, whether we go ahead with this expansion or not. And of course, there's the non-monetary costs. So it's the customer satisfaction, etc. We'll have a look at those. So in order to be able, we only take into account relevant costs. So if it's not relevant or irrelevant, it goes out of the cash budgets, it goes out of our analysis. So what do we mean by relevance here? Well, it must relate to the business. So, and it must, and assuming that wealth creation is the objective, then the cost benefit must affect this objective. So if we are doing something that is, and it doesn't relate to the business, then it's not relevant. I know that sounds really obvious, but again, it's really easy to get sidetracked, particularly in small businesses where they have it's part of the hobby, it's part of the passion. So might mean that you don't see wealth creation as being your sort of just sole driver. It has to be a future cost, because if it has already been in the past, then it's irrelevant. We've already incurred it, and it must vary depending on our decision. So it's only costs that differ between our outcomes that we should use to distinguish between them. So here the cost of a driver is relevant, because if the delivery service doesn't proceed, he or she's not needed. So that is it will vary depending on the decision. So if our decision is no, we won't get a driver, we won't incur the cost. So, and the sunk costs, as we said, so the market research that has already been paid for because of those principles of relating to the business being a future cost and varying with the decision, we can see that the market research that's already been paid for is a sunk cost. It's incurred regardless of whatever we do. We've paid it. We don't get our money back. Therefore, whether we make the decision or not, it's irrelevant. And the committed costs, which are our costs of employing Dave, remember we've already got the part-time employee and he's got some spare capacity. That's a committed cost. We are going to be paying that regardless. Both sink costs and committed costs are irrelevant, but they are important. So as I say, what I do find is lots of people always, when they're doing budgets, they always try and throw in these irrelevant costs and allow it to influence their decision. And really want to talk about the sunk cost fallacy. Again, if you work within accounting, you will have come across this, I'm sure. And this is your irrational refusal to abandon an attachment to an irrecoverable investment. So it's, I have spent money on this, so even though I'm making the decision that I'm about expanding my business or taking a particular course of action, the fact that I've spent this cost is going to guide what I do. The sunk cost fallacy. It's actually persisting with a course of action because of your previous investment in time, money, or energy. And we see it again, it makes no sense, but it really happens all the time in reality, unless we're really strict with ourselves. So I've just put that, it's a really sort of famous one, I guess. The story of Concorde. It was pretty obvious as they were building Concorde that it was never going to make any money, but the French and English collaboration had put so much money into it and had talked about it so much and were out there in it that they carried on regardless, victims of the sunk cost fallacy. It's like you might hear it, pouring good money after bad or failing to cut your losses. As I say, it happens all the time, and it can turn a good business into a sort of fairly bad one. Why do we do this to ourselves? Well, we've a natural loss aversion. So there's a natural tendency to dislike wasting resources. So in our example, we have spent money on market research. And if we have the market research, we spent that £1,000, we kind of want to get it back, even though that market research has told that it might ultimately tell us that it's the wrong thing to do. Wishful thinking. So we just kind of, well, maybe it'll turn out better than we thought. And also fear of what others might think, which I think is really the Concord project was around that. Okay, let me just check. Yes. So Jan, yeah, that's useful. But maybe they would have been better to pay all the costs with than carry on. Maybe not. So I don't know. So there was just, as I said, there might be lots of reasons. So I could add another bullet point to this to go to Jan's point. You've got the loss aversion, you've got the wishful thinking, you've got fear of what others might think, but you might also have legal commitments and really adverse repercussions if you don't proceed. Add that to our slide. Thank you, Jan. Okay, so in the context of our example, we might have our, so looking at our relevant costs and dealing with labour, first of all. Whenever we're building in costs for labour, we have to differentiate between spare capacity, which is no relevant cost because it's already a committed cost, whether we need to get new staff, because that is a future outlay, so it is relevant cost. And when we've got existing staff redeployed from another task, that is also a relevant cost. But here, it's not the outlay cost, it's the opportunity cost of the diverted labour. So if we look at what, just to remind us what we've said about the labour relating to the expansion idea, we've got that Jay is going to do the marketing, so that's spare capacity. Dave is going to do the order processing, which again is spare capacity. So these are not relevant because they're already committed. Holly's going to be redeployed. So there is a relevant cost there, and that's going to be the opportunity cost of the diverted labour. And then where driver needs to be employed, which is a future outlay cost. So just to summarise that and just to clarify that the opportunity cost for Holly is going to be the loss of profit that we get as a result of Holly no longer making cakes. So we told it's £60 on 12 cakes. We're losing effectively £720 per month by diverting her from the cake making to the sandwich making, and therefore that has to be included as a relevant cost. This opportunity cost is often something that's ignored in reality because you just think, oh, you tend to do it on wages, but your opportunity cost, hopefully, unless they've got spare capacity, the opportunity cost is often higher than the wages involved. It depends on what they're doing. The driver, again, it's £15 per hour for 25 hours per week. And that's £1,500 per month. Remember that when we are dealing with labour costs, we don't just actually have the wages. And in terms of the wages, we do need to think about the national minimum wage and the national living wage, particularly if people are switching over ages. So, we might go out and get somebody who's 20 and do it on one cost, but if we've not focused in on the fact that they're going to go into a higher category very shortly, then we'll miss that. We've got to think about our national insurance costs. So although we've seen national insurance massively in the news over the last couple of weeks, none of it actually impacts on employers. So your employer's national insurance remains a 13.8%, and it remains quite, it's a chunky outlay. So although it's deductible from corporation tax perspective, although if you are below a certain size, you get an employment allowance of like 5,000 a year, it's still an absolute cost that you must build in. And then we've got the other costs, the health and safety costs, public liability, employers' liability, insurance, any sort of benefits that we provide that's additional. Remember, we're not really looking at committed or sunk costs. We are looking at sort of future outlay. So just bear that in mind with new employees. It's not just, as I'm sure you all know, it's not just the hourly rate that you should pay them on. Okay, so for materials, we'll build all this in shortly. For materials, it's going to depend again, are they already in the business but will need to be replaced because they're used often? That's an outlay cost and therefore is relevant. If we've got them in the business but they're not currently used, then we've got a relevant cost, but it's the opportunity cost there. So we'll come back to the cardboard boxes, or do they need to be newly purchased? Again, it's a relevant cost, it's an outlay cost. So pretty much material costs are usually involved. So we've got ingredients and cardboard boxes here, and the ingredients are clearly a future outlay cost. They might already be in the business, so might have flour, but they will need to be replaced. So we would just literally include all the costs in that. The cardboard boxes, so it's like here they're not relevant. Although the cost would normally be the lost opportunity cost, we're told there's no intrinsic value. So there's no cost is actually should be included in the decision making for those. We're going to use them up. We might think, oh, that's great, we've not got a waste, but fundamentally it's not something that we should acknowledge within our cash budget. Okay, now other monetary costs, obviously these are individual to each project, and we use those general rules of limiting to relevant costs. You know, does it relate to the business? Is it a future cost? And does it vary depending on the business decision? And for Lazy, I've got Lazy Z Bakery there. Sorry, that should say Lazy J. Other costs are plant and machinery. Well, they're not relevant because they're a sunk cost. We already have those. We've bought those and we're using them. The sign writing is relevant because it is a future outlay. It will vary if we don't use the van because we're not doing the deliveries. We don't need to do the sign writing. We've got the additional packaging, which will be relevant because it's a future outlay. We've got, cardboard boxes, but they're only going to go so far. We've got the additional running costs of the van. That's relevant, and it's a future outlay. Now, in terms of the van itself, which should be there but isn't, so the van we would include because we've actually got an offer to buy it. So although we will, an offer for someone else to buy it from us for £8,000. So although we would say we've already got the van, and therefore it's a sunk cost, it isn't, because we could have the money. So by deciding not to sell it, we're actually losing £8,000. So we do need to build that in. So that's the opportunity cost of that. So in terms of our non-monetary costs as well, these are really hard to measure. And often the impact on the business is not immediate. It tends to have a real tail on it, but it will affect the ability of a business to achieve its objectives. So for example, if we overwork our employees, you know, we've said Dave can just help out, he's got some spare capacity, you know, if he doesn't, then ultimately he may leave. We'll then have to invest in getting a replacement. We might have things like other qualitative costs and benefits might be customer dissatisfaction. You know, we're starting a new thing that might spread us too thin. Something might happen that damages our reputation. So you could run over someone whilst he's out delivering. We've got demand. We've done our market research, but it costs £1,000. It will be limited. So we might suddenly find that something happens to that demand and those numbers do not materialize. And how do we actually build that into our costs? And then we might have collateral benefits that we cannot monetize. So we might get more customers through the door. We might have an improved brand loyalty. Who knows? We might sell a sandwich and then someone might order a birthday cake because they like the sandwiches so much. I mean, that's what we're hoping for, but we can't actually monetize that at this point in time. I know it would be, you might say we're very, but we can't include that. They're just really tricky. So it's how do we go about that? We've two choices. We can disregard the non-monetary costs, or we can put an element in for it. My thoughts would be to bear in mind the limitations of budgeting is accuracy. My thought at this point would be to ignore the non-monetary costs that we cannot identify. If we can identify it, it ceases almost to be a non-monetary cost and becomes a monetary cost, and then we can apply the general principles. But that might not always be the same when we come to the end of June with this expansion cash budget. Some of the non-monetary costs may have realised themselves. So so putting all that detail into our cash budget using the formulas and the setting that we had before. So our receipts is going to be our cash and this is purely limited to the sandwich sales. So it doesn't incorporate the rest of the cash budget from the retail bakery. But we've got the cash coming in. Assuming that we've got the same level of credit sales, we will have like 1,800 coming in January, but against our costs of the van, you see with the opportunity cost plus the sign writing cost, we've got our salaries, which we've calculated that. Other costs, I've just randomly put that in. And we can see that at the outset, we will have be down nearly £10,000, but that is primarily due to the van and us recognising the opportunity cost. And we can see that then as we get into February, we don't have the van, but we are sort of starting to amass. We'll have to pay for the materials that we've bought in January. Therefore, we have higher cost of materials, and fundamentally, we've dragging our we have a much lower net cash position. We've only lost out just over £1,500, but we're dragging this 9,920 from month one, and so we keep going on. And by month 3, on the numbers that we've got, we are starting to make a surplus, but we're still dragging our initial outlay costs behind us, and that improves until we get really at the end of June. We are steadily making more cash than we're spending, and we have nearly eradicated our closing balance deficit. So, as we said, just some notes there, which I think I've covered everything. Yeah, because so lost opportunity cost, although you might say it's not a cash payment as such, and I said it was an exchange of cash, we do have to include it. You might think, well, that's like doing my head in because you said it was an exchange of cash and you've included it as an outgoing when it's not. It's a lost opportunity cost. But what you might do is if that is doing you know, if it's blowing your mind, then you could actually include it as a negative amount in the receipts section as like a loss of expected revenue, because it would be. It's actually you were expecting to get 8,000 in and you're not getting 8,000 in as a result of deciding to use the van in the business. Remember, there's no set format, so if you want to think of it like that, then you can. We've ignored the costs of Dave and Jay. The cost of Holly is the opportunity cost, not her salary costs. I've just put the as I say, £500 per month in for the running costs of the van, etc. Just want to make the point that market research costs, cardboard box costs, the cost of the plant and machinery, and the utilities are all ignored in that other costs. So there's a reason for that, because they're all irrelevant costs. And then, as we say, we've started with a balance of nil, because we want to consider the investment in isolation. So once we've got that, we can kind of say, well, you know, we can make a decision because it's still operating at a loss from the cash budget after 6 months. We're like down £720 overall in the 6 months. However, if the sales stabilise, because we said we'd be 2,000 a month, then the cash flow will become positive from July, and we will generate 3,280 surplus per month. The deficit, as we've said, is primarily due to the lost opportunity cost on the van. So if we do decide not to go ahead, then we should sell the van. We've got it not used in the business at all at the moment, but if we've clearly, it's a varying cost. So we should get that money in if we decide not to go ahead. Now, from the original, and this is where our original cash budget comes in. So from the original cash budget, we've got a comfortable cash surplus. If you remember, we were up in the post above 30,000 at the end of June. And the only the monthly cash surplus that we had can easily or just about absorbs the cash deficit. The only exception for that is January, where we have the big lost opportunity cost. Now, we might, under those circumstances, we might consider whether the implementation should be delayed by a month to put us in a stronger cash position. But remember, it is the opportunity costs, it's the limited of the revenue. So we might decide to just really go for it. Now, just making the point that the original cash budget is affected by the loss of 12 cakes per month, which is 1,200 revenue before the adjustment for costs. So we need to sometimes go back. If we've loads of lost opportunity costs, we need to think about how going ahead actually impacts on our original budget and adjust it. But on the whole, given everything that it's £1,200 revenue set against, you know, in most cases that's less than 10%, we would not consider that material. Thinking against like a 30,000 revenue, we should be okay. And we've not in this. I've like wimped out a bit, and my non-monetary costs and risks have not been factored in at this point. But again, as I've said, we'll come on to risk because we've not talked about that. The non-monetary costs are really hard to monetize in this particular scenario. They don't seem huge, you know. Okay, but we do have to factor in risk. If you remember the original balance, we had on one side, we had the benefits, and on the other one we had like the cost, the benefits foregone, and the associated risk. So here it all looks good, but if we factor in risk, that may tip the balance and decide that it's not something that we particularly want to do. And the risk is the chance of the outcome not being as predicted. So examples that you might be able to think of is no one using the delivery service, a customer getting food poisoning, which has like a real knock-on effect in terms of people not wanting to use the delivery service, but might actually damage your existing business as well. The van breaking down, so we need to replace it. We've got unexpected costs and cost changes. I'm thinking here particularly to ingredients and utilities, and maybe staff costs that make the original decision unviable. So that lack of predictability, this managing of risk, is like something that is become really common in the current economic environment. And I say current economic environment, but let's face it, we've dealt with risk and uncertainty for probably the best part of 5 years now. So another risk is not that we've failed to predict something. We might have actually just got it wrong. So our costs or our benefits may have been inaccurately estimated. There might also be something that's really sort of out there, which is that no one could predict. So COVID, we must like need to try and move on with that, but we keep getting that, don't we? We've got the COVID, we've got the invasion of the Ukraine, things that we just like, whoa, that we weren't really, how can you predict that or do any scenario planning against that? Now, the greater the potential that this scenario that we've put is can deviate from predictions, then the greater the risk. So we have to do our business decision is based on weighing those outcomes. So a net financial benefit that we've calculated against of the 3.2 thousand a month against the risks that either the benefit that we achieve is lower than we've expected and the costs are higher than we've expected. So when we do this, we need to sort of think about a sensitivity analysis. There's loads of tools for assessing risk, but we let's go with like the most common one. So what we do is we look at the what ifs. We make an initial analysis based on our best estimates, which is what we've done so far. And then we test each input to see how much it can change before our project becomes unviable. So we're not looking at like what might change. We're just assuming it will change, but we're looking at what we call like the tipping point. And that is at what point can the input be before the net financial benefit becomes zero? So for example, if after 6 months our monthly net financial benefit, as we've calculated, is 3,280, then it follows that our monthly sales could be 3,280 less for our monthly net financial benefit to be zero. Our relevant costs in total would have to be 3,280 more for the monthly net financial benefit to be zero. Now, in practice, when we do this, you actually look at each cost in isolation, and because it makes up the total, but sort of in the I'm thinking you're kind of getting the point. So the difference between the value for each input at which the net financial benefit is and its estimated value at zero, sorry, which the net financial benefit is zero and its estimated value is our safety margin. So we've got a safety margin on sales of 3,280. And that can be either, and it could be a combination of both. So we can use that, and if it's complicated, you use a computer spreadsheet. So you open and you will have programs typically to do this for you, but that's all it's doing. It's like what actually can happen. What is our safety margin? How much can our costs go up before it becomes unviable? How much can our sales go down before it becomes unviable? And we've seen from our cash budget and analysis that our steady state after 6 months should be that we are generating a net cash benefit of 3,280 to the business. So we can work on that. So in terms of thinking about our net financial benefit, we've actually got to it through our cash budget. But just stepping back and saying, oh, right, I want to do a sensitivity analysis generally, remember that our net financial benefit derives from all of those factors that are put onto our slide. What is our price? What is our volume? What is our initial outlay costs? What is our project life, which we've not really discussed here? What are our operating costs and what are our financing costs? And those are each of the inputs that you would look at. And so, as you say, we've only got so many levers to pull. We know now what our safety margin is. We've got 3,280 to play with. And I guess the risk is where you take a longer period view, because you might think, oh, if one month everything seems to have gone up, but you think you're going to get it back. So we'll talk on to, we will have to come on to control later on. Now that sensitivity analysis has some obvious shortcomings because it's static most of all. So if we only alter one variable at a time, that's how you do a sensitivity analysis, and calculate sort of the safety margin. But once we alter more than one variable at a time, then it becomes scenario building, which again is something that you can do with the business. So it's not a sensitivity analysis then with scenario building. It might be something that you want to do or your clients want to do. But fundamentally, it's a logical process that we go through. We've identified what our current cash position is. We've thought about our different expansion ideas. And I must admit, when I first started doing this session, I had about 4 ideas. And I thought, oh, we could just compare them and say which one we would go for. And that, of course, is something we could do. But then realised that I wouldn't really be able to fit much in around control, which I think is an important part of this topic. But we could easily, if Lazy J Bakery had come up and said, we don't know whether to do a delivery service, or we don't know whether to start catering for weddings, or we don't know whether to do both, you would run sort of cash budgets and analysis for each of those and then compare them. And then each input into each of those would be tested for sensitivity to get our safety margins. And one hopefully would emerge or none would emerge. Here, I'm not seeing anything really that would say that we couldn't react quite quickly if it turned out to be too much risk. But we're doing it at a very low level. You might have really massive outlays and then the risk becomes much higher. So it's static. We don't know whether the inputs are likely to change or not. All I've done when I'm doing a sensitivity analysis is said, oh, my sales can reduce by 3,280 per month before there's a problem. That's my safety margin. It's not actually telling me whether that's going to happen or not. Equally, we don't have any rules whether to accept or reject a project. When we're doing some sort of valuations about long-term investments, we might look at net present value. We might decide, well, actually, we don't get the return on that we were expecting. But here, when we're looking at a project that's around sort of cash generation, then we don't know whether to accept it or not. It's just our experience there is saying, you heard what I said. I was like, oh, well, we don't know if the sales don't happen or if the van breaks down or if we can't get a driver or if all these things we don't really know. One is £3,280 safety margin enough? If we feel it is, fine. It probably is here because we can easily pull things back fairly quickly. But if it isn't, then you might have to build a bigger safety margin, which would include adjusting your sale price, maybe doing some more marketing. So the whole thing is to help us with our business decision making, but it doesn't make the business decisions for us. Okay, so now I talked about the managing the cash. We talked about not letting it run too rich. Otherwise, we sort of we tip into a negative positions in terms of the cost of finance, lost opportunity cost, jeopardizing our tax status, etc. We've also how much do we need in terms of what happens when it gets too short? Well, there are various models out there that help us control our cash balance. Again, this is likely to manifest itself in the form of some sort of computer software. And it's not my role today really to talk about and compare software packages, more to really look at the theory behind it. So one of the ones that you would think about is the control model. And this involves us identifying a target balance that we want to have based on our outgoings and expected outgoings that we've budgeted for in our cash budget, and giving ourselves 2 limits, an inner and an outer, which looks like that. So we've effectively here, the thick black line is our cash. I've got this grey line, which is my cash target. Don't click on it because it's going to be, hang on, I've got one down here. I've got a laser pointer down here. So I've got my target cash balances here, this line. Our outer limits are the red lines. Our inner limits are the dotted lines, and our actual cash position is the black line. And what we would look at is at the point when it starts falling below our inner target, we start thinking about it. We start getting worried, and we would decide how long we would be prepared to wait before we take action. because obviously the second it dips, you might be like, oh, we need to do something. You might want to give it a little bit of time, but not long. And we see here it's now hit our outer limit. Now we have time for action here. We can see actually it's turned itself round and gone up. That's probably because of some intervention. And then we can see it above here. So whilst it lives within these two inner limits of our target balance, then we're fine. But with the second it starts going, then we start thinking about whether action is needed to bring it within that range. Now, what your target balance is and what your range is totally dependent on the need of your business and your cash outgoings. If you're not paying any cash out, you need less cash in your business than otherwise. Okay, let me get my... take that off. So, as we say, it's you usually talk about days for this, I have to say. So if it goes out of your outer limits, then you expect it to return in the next few days. If it doesn't, then you will have to do some steps. And that's usually like, have we got too much? Do we need to invest it? If we've got too little, we need to start about thinking about realizing stuff. And again, your time is going to depend how difficult it is to realize cash. If everything's sort of illiquid, you need to act sooner rather than later. Okay, and we say a management judgment here as to limits and length of the return period. Okay, and then the other model that you sometimes see is the cash equivalent of the inventory economic order quantity model, which assumes that demand is constant and that we spend all our cash, reduce it down to nil, and then we replenish it back in full. And we pretty much work out that our economic order quantity is where D is the actual annual amount that we need in cash, C is the cost that we incur, and that's our costs that we incur in acquiring the cash. It's not the cash we spend, and H is the cost of holding £1 for 1 year. So we run that, and then we can see how often we should be looking to replenish cash on that basis. Okay, so they're just two models. The control model sort of kind of makes more sense to me as a non-accountant, but the software could easily be built on an economic order quantity basis. So the other thing that we need to, as we start into managing our cash, so that's we've just looked there at controlling the cash level, not letting it get too like erratic, and making sure that we take action if it does start becoming erratic. The other thing that is an essential element of cash management, I will keep going on this one, is the operating cash cycle. And the operating cash cycle is looking at the period between when we do the outlay. I've put tax there, it's cash. Well, it was just, so sorry, there's an error there. Essentially, I'm looking at the period between the outlay of cash for the purchase of something and the ultimate receipt of cash from their sale. So in the context of Lazy J, I'm looking at when they buy materials to when they get paid from the sale of the sandwich, whatever. So that is my operating cash cycle, literally the amount of time that the cash is tied up. It has a huge influence on the financial requirements of the business. Some people's job is to bring the operating cash cycle down, because it's obviously the larger it is, the more problem, the more risk you've got, because the more of your money is tied up. So as it says there, the longer the cycle, the greater the financing requirements and the greater the risk that's involved. And so it means that if you've got a short operating cash cycle, so the turnover, effectively the period between spending money and getting the cash for it, that's when we would say they've got a really strong cash flow. A cash flow is different from cash. So up to now, we've talked about having sufficient cash in the business. The cash flow is the ins and outs of it. So the operating cash cycle is the shorter it is, the stronger the cash flow. And so the operating cash cycle is effectively the average inventory turnover period. So how long does it take us from buying in stock or ingredients to selling it, plus the average settlement period for trade receivables. So we might actually be able to turn around our stock in a week. But if we're not paid for that for 6 months, that gives us a really long operating cash cycle. So that's that average period for trade receivables. But from those two, the sum of those two, we can take off the average settlement period for trade payables. So if we're buying on credit, like the Lazy J Bakery, they bought all their ingredients on account and didn't pay for it until the following month, that we can take that off our operating cash cycle, because that's even though we've bought something, we have the cash to ourselves. It's almost like buying, using a credit card. We still have use of the cash until we have to pay off our credit card bill. So the inventories plus the average settlement period minus the average settlement period for trade payables is our operating cash cycle. Okay, so if a business buys and sells on credit, then the operating cash cycle ratios can be worked out from the accounts. So we can take the accounts, bearing in mind that that might be dated. It might be the last financial accounts, but we can use the ratios there to work out what our average inventory turnover period is, our settlement period for trade receivables, and our period for trade payables. Now, I will use those a little bit, but that's just where I'm just including that as a slide in case you're thinking, I might go and work out what a client's operating cash cycle is from their latest accounts. And I might be able to see where that fits against like averages and whether this is a business that needs help with that. And we can have like a proper conversation about it. I always think of all this that we are going through. They're all reasons for conversations, and conversations are sort of ultimately leads to work, doesn't it? Leads to business. So I've created a new one because for me at this point, Lazy J is doing a little bit too well for us to be really focused on its cash operating cycle. So we're going to Icy Blast Limited, and they are an ice cream distributor to both the retail and the hospitality trade. And we've got the accounts from the year ended 31st of December. I've not bothered with a year. I've made these up, so it's but to prove points. So if you look at it and think that's a realistic, it probably is for a reason. So I've got 710,000 of sales revenue, which after we've gone through everything, we've got quite we've got some 176,000 in stock at the end of the year. Our sort of 125,000 in ordinary expenses. We've got 12,000 in financial expenses. And we ultimately are ending up with net profit after everything, taxation of 22,000. So it's not like got the biggest gross margin that we might have, but we are here. From our assets, we have a effectively 14,000 in cash. We've got a huge number of trade receivables. So our debtors, well, trade receivables is wider than debtors, isn't it? Debtors is when they owe us the cash. Trade receivables technically also is when we have made the sale, but we haven't delivered. So it's the, we've not got debt as such, but we've got a committed sale. And so that looks quite large. We've got 159,000 at the trade creditor level that we are owing out. Okay, so we can use that to think about it. So using the ratios that were on the previous slide, we can see that our turnover period is 110 days. Let me not click on it. We can see that our average settlement period for trade receivables is 136 days. And we can see that our average settlement period for trade payables is 102 days. So our operating cash cycle is 144 days. So we're talking, for nearly 5 months between buying some ice cream in and actually getting cash for that ice cream through the door as an operating cash cycle. It's pretty shocking. So that would be where we would need to be, because according to PwC, they do a report every year. It's pretty useful. Is 23-24 report. The average operating cash cycle days are between 41.9 and 48.2 days, depending on the size of the business. And they do, to be honest, their inputs are from fairly large businesses, but this is like our ballpark. We're looking for 50 days less. So if we've got a business that's at 144 days, we need to do something about it. So if we want to reduce our operating cash cycle, it's probably not rocket science. We have got effectively 3 variables that we can push. So if we can reduce our average inventories turnover period, or reduce our average settlement period for trade receivables, so it's like sell our stock faster or have less stock in the first place and get paid quicker, that will improve our operating cash cycle. Or if we actually are able to increase the average settlement period for trade payables, that will also assist. Now, the first 2 is all about operational efficiency. Can we improve our inventories control, and can we get our credit control procedures under control without adversely affecting the business? The last does need caution, because what we're really saying is if we want to increase our average settlement period for trade payables, it means we're paying people, our suppliers, slower. And that actually can then disrupt the relationships with those suppliers, damage our reputation, and might actually breach our payment terms. And they may withdraw our credit. So, we just, again, just because we've got variables to manipulate doesn't mean we should go for that. We really need caution about the last one. But there's no real reason for not getting the first 2 into an optimum place. Okay, so bear in mind, before we start and look at this, we will have a break before we look at how we actually generate some short-term finance. We've got to remember that not all days in the operating cash cycle are equal in value. So if we look at ICIblast, as we've said, the operating cash cycle is 144 days. If we increase our debtors and our creditors by 7 days, because of the formula, 1 + 1 minus the other, we'll end up with exactly the same operating cash cycle, because we'll so 144 days. However, if we did that, we actually tie up more of our working capital by in 2,723, because we do increase our amount of debtors, and we also increase our suppliers, but we increase our suppliers by less because of the numbers that we've got here. That wouldn't necessarily always be the case, because it's going to depend on your numbers, but it kind of makes sense that if we track our creditors in the same way that we get debtors, so we say, it takes our people 3 months to pay us, so we're not paying our clients we're not paying our debts until we've got money in, so we get that increase in both, we're effectively going to adversely impact on our working capital. As I say, I'm probably sort of stating the obvious here if it's something that you deal with on a regular basis, but if you've not come across it before, it's kind of like, we've got to really challenge ourselves before that mindset, because I have heard that mindset of like, we'll pay you when we get paid. And I would just say, okay, well, run the numbers and make sure that that's actually not making your position worse rather than better. Okay, so that is our time for our next break. So thank you very much. Let me get that in the chat. Sorry, Jan, I missed your question. I will come back to it after the break. I've just seen it now. So we'll do another 10 minutes. So maybe say back. You will say back at 10 past. Okay, so welcome back to part 3 of the session. And we're now moving into thinking a little bit about short-term financing. It still links in with the operating cash cycle because one of the key aspects of short-term financing is actually how can we generate that internally. So if we just sort of take a step back for a moment and think about short-term financing, the key sources are internal, which should look familiar to you from what we've done this morning. It comes from tighter credit control. If we can reduce inventory levels, or we can delay payment to our suppliers, all of those have a cash benefit to us. External, we've not touched on at the moment because we've been looking purely internally. But external short-term financing is bank overdrafts. We might also think about debt factoring and invoice discounting. Both debt factoring and invoice discounting are a kind of sort of almost asset-based finance. And a bank overdraft is the thing about bank overdraft is that is short-term finance, but the way a lot of businesses use it is that they don't ever sort of pay it back, so it actually trips into being long-term finance, which is it's an expensive form of long-term finance. But we'll come back to those because none of those are to be dismissed as a potential need of sort of injection into the business, but they obviously come at a cost. The thing about internal finance is that it's all about sort of improvement. So if you are optimum at the moment, there's limits to what you can do with internal financing. You might have to go external, but when you go external, there's obviously a cost to that. So let's look at each of those in a bit more detail and see how we can switch the theory into some sort of practical thing, because it's all right saying, oh, well, let's reduce our operating cash cycle. But the obvious question that follows that is how? So if we take one of those is tighter credit control, being the thing that is going to effectively reduce our average period for when we get payment in of our trade receivables. If we can be successful, then we will reduce the funds that are tied up. It will improve our working capital that's available. It also reduces the lost interest that we've had by not having those monies in our business. It improves our purchasing power because we've got more cash to play with. And again, that converse, it's almost the converse here of not having enough cash. It'll reduce our risk of missed opportunities. It also reduces our administrative costs because we do waste a lot of money, or some of the clients that I've looked at waste a lot of money in terms of getting the money through the door. Also, we minimize our bad debts because slow payers can easily change into non-payers if sort of financial situations get the better of them. And also we can avoid the need to offer cash discounts for prompt payment. I want to deal with cash discounts on their own because they're like seem to be an almost go-to thing, but might not necessarily work for your business. Now, against there's not many downsides to tighter credit control. You could say, well, I might have a loss of sales to competitors if my competitors will provide more credit terms than I will, and I might lose customer goodwill because I'm asking them to pay. Now, I think there is ways that they are real downsides. I'm not diminishing them, but they are also downsides that can be managed through good communication and being sort of clear up front. So it's it's something that we can manage if we think about it. But I'm not dismissing it totally, but it's like on that balance, go back to that slide, there's a lot of benefits on the on one side against some often cited, but how real are they, downsides? Okay, so my quick guide to receivables management here is establishing a clear policy as to, sorry, because my mic slipped there, probably got a bit of feedback. Establish a clear policy. Whatever we're going to do, let's make sure we know what it is. Once we've decided that we are going to offer some kind of credit, then we assess and monitor our customer credit worthiness, because you might say, oh, I'm going to give everybody your policy might be to give people who have bought from you in the past 2 months a 30-day sort of account. But then within that, you've then got to make sure that the individuals you accept into that are actually good for that credit. We need to establish an effective administration regime around it. It's no good having a policy and then not collecting on it. We need to consider cash discounts for prompt payment. It does exist out there, but we do need to work out how it actually impacts on our business. And we need to determine and use our operating cash cycle. These things are there for a reason. Another thing that's useful is aging summaries. So I'll come on to what those are in a minute. Just remember that if you sat there and you're thinking, I don't actually extend credit to anybody, if you have a debtor, you extend credit, and you might say, oh, well, I only give them 30 days. But if you don't chase them down until they've, immediately on those 30 days, you're actually giving them 60 days. So if you decide, oh, we let people pay in 30 days, and then at day 60, you start looking, you are actually, your policy is to let people have 60 days credit. And so people will take advantage, because why wouldn't you? Because the other driver is paying as late as you possibly can. So you can't blame them for doing that. You would want to do it yourself. So your clear policy, as we said, is where we start, and it has to be consistently applied. If it's consistently applied, then you can help manage your customer satisfaction. It also helps your staff when dealing with enquiries. How much better is it if your staff says, yes, we have an account in these circumstances, you'll need to speak to X, here's their number, then like, oh yeah, okay, I don't know what we do, I'll find somebody to talk about that. You're not being fair to your staff if you are expecting them to handle credit without actually saying what your policy is. Or even if you decide no credit, even that decision about saying, you know what, we're not having credit cards unless there's a minimum purchase of £10. It needs to be like super clear and super articulated. So when we're doing that policy, we need to think like, well, which customers should receive credit, if any? How much credit should they receive? So what is our financial limit on that? What length of credit should we be available? And are we actually going to police that credit? It's easy if somebody comes in and buys, I'm thinking of Lazy J, they come in and they buy a sandwich and they're not leaving unless they've paid. We're still making a decision about credit if we're deciding to take credit card payments. So we have to consider, as I said, communication helps with everything. I have to say, I can see no downsides to not communicating, unless you don't ask for credit with no credit. Then your staff need to know there's no credit, and you need to probably communicate it in a reactive way when clients inquire. Monitor it all the time. Is it working? Is it reducing our operating cash cycle? Are we actually, is it worth it? Is it worth the effort? If it isn't, do we need to adjust it? Do we need to review it? So many people that I know spend a lot of money on getting policies together and then don't bother monitoring and reviewing it because they don't have time, because as we said right at the very beginning, it's really easy to get sucked into day-to-day issues. And so that just becomes lower and lower down your list of things to do. As I say, I'm very aware when I'm saying this, that I'm saying I'm working in an ideal bubble. It's all right if you turn up and you've no staff because they're all off sick, you're going to be dealing with that, not reviewing your credit policy. So, it's got to be realistic, but it depends on where we are cash wise. So the length of the credit period, what's my thoughts? Well, it's going to depend on your industry, your degree of your competition, and also the bargaining power of your customer. So you might think, nobody's getting beyond 30 days. And then somebody might come and say, yeah, we'll buy this quantity off of you, but our terms are 60 days. You've got to then weigh up whether that's like worth it for you. And as you say, there's mathematical ways of dealing with that. Competition, it depends what everybody else around you does. So if everybody else is offering 60 days, you can't, it's not really, 30 days might not be the right place to be. But as I've said, just because all that's going on, the person comes and says, we'll buy this off you, but we want 60 days. Everybody in the competition offers 30 days. There's no point going with that unless you can make it work for you. Be aware of it. And but they are just factors to take into consideration when looking at the impact on the business. And the impact on the business of credit is the cost of the finance. So it's like, actually, how much are you losing in terms of interest? How much, if you've got an overdraft, is it costing you to give this credit? And so the average amount that's owed to the business at any point is our daily sales revenue multiplied by the time to pay. And so in our Icy Blast example, I thought if actually we took 30 days as our credit period, the average amount that would be owed to Icy Blast Limited at any one time, based on the accounts that we looked at earlier, would be 58,356. If we extended that to 60 days, which is, long by anybody's standard, that is, as you would expect, doubled, 116,712. When I applied our actual days to our time to pay, which is our 136 days, we can see that actually at any one time we are owed 264,548. Well, for a business that generates revenue of 710,000 a year, that's in excess of like a third of our revenue tied up owing to us at any one point, which is like we've got to do something about that. But you can see that actually you should run those numbers if you're making a decision, because even 30 days might be too much depending on what your sort of sales revenue is. Okay. And it may be then that you think, well, actually, we do have to offer 30 days because that is what the competition says. But we're going to be super selective about who we offer that to so that we can make sure that we keep the amount of money tied up to a minimum. So there are different levers that we can pull in the policy. In terms of credit, customer credit worthiness, once we think, yes, we will offer credit, yes, we will offer it for 30 days, say, but we're not going to let that expand by failing to collect it. Obviously, every time we do credit, it carries a risk, and it is the norm. I'm thinking about sort of the businesses, even within my immediate family, and we have service industry, we have manufacturing, we have construction business, and credit features in all of those. When we decide who we offer credit to, you've probably heard of this. We refer to the 5 C's. So the 5 C's are capital, capacity, collateral, conditions, and character. Often maybe not set out like that, but that's the way you would remember it if you were studying this. So capital is just like, is the customer financially sound? We're going to look out there, we're going to see, do we believe that if we give them the credit, they'll still be here in 30 days to pay it. And the capacity is kind of linked that. So financially sound, but do they actually have the capacity to pay for the goods acquired? So there's a difference between being capital backed and having the cash. So we might look at that in order to sort of work out the capacity. We might look at whether they've bought things from us in the past. and whether they have had a good record of payment with us. It would indicate if they've paid regularly in the past that there's no reason why they wouldn't have the capacity to go into the future. Collateral. Do we need some kind of security or bond? Depends very much on the industry we're in, whether we can ask for that, and if so, what form that could take. But again, we're looking at the 5Cs is generically applied. Conditions, that's not internal conditions or conditions of that we apply from a contractual perspective, but rather what is going on out there in the world. And how sensitive is their business, not ours, to changes in the economic environment. So if we are operating an industry where something changes, and they are usually vulnerable to that. So for the discretionary spend, say, business, then we might think it might be all right today, but actually it's super risky in the industry that they operate. The character is like, do they have integrity and a willingness to pay? So again, we might look at past records for that. As we say, useful sources there for information when we're looking at all these 5Cs. Well, we might seek trade references, might seek bank references, published financial statements. They could be outdated. Bank references and trade references. Well, trade references, they are often picked by the customer so that you make sure you get good ones. So those bank references, banks don't really like to do anything other than generic ones. They don't want to get themselves on the hook for professional negligence. So that's understandable. So that limits there. It's useful, but it's of its limitation in terms of what you can rely on. Published financial statements can be out of date. They're also prepared to accounting standards, which might not reflect the actual position. You've got the customer. You can ask yourself whether they've been, that's really their history, probably what people sort of rely on. And then these credit agencies, the register of county court judgments, both of those cost to access, and other suppliers. Building up your network of other suppliers, you might share details of people who are not good payers or not. That's tends to be very informal. So there's limitations on all of those, but together they can give you an indication of creditworthiness and hopefully diminish your risk. And of course, you have to weigh that with the risk that if you refuse somebody credit and they believe they should have it, chances are you're going to lose the sale. So it is something to focus on and be sort of quite careful about how you do it. And I think it's probably far better to set parameters. So my husband, as I said, he manufactures custom skateboards. He sources his wheels for his online store from a particular supplier, and when they set up their deal, I remember from the contract he had to provide references from other suppliers, and he had to trade with them for sort of about 3 months. It is from the US, so it makes sense what their requirements. But he had to trade with them for 3 months on a sort of cash on delivery type arrangement before they were like, yeah, we're cool. You're in another country, you'll pay, we're fine. And then he moves into his sort of credit account. So he's on like 30-day terms with them. So it just is like that course of dealing seems to be the most heavily relied on. The cash discount conundrum, then, that's what I just wanted to talk about, because a lot of people think about, might say, oh, we'll give a discount for prompt payment. And sometimes that's good and sometimes that isn't. But again, if we take the emotion out of it and look at the actual cost of finance, then we can see whether it works for us. So using IC Blast Limited, so I can illustrate what I am referring to. We know that they've got an average settlement period of their trade receivables of 136 days and 710,000 sales revenue. I'm just going to say its current cost of finance is 12% and its annual bad debts are 30,000. They're just numbers that I've selected to illustrate the point. So if it's considering offering a 5% cash discount for anybody who pays within 30 days, so we are, because it needs to do something, doesn't it? It's believed that 40% of the customers will accept this facility, but actually the remaining 60% are going to take 150 days, so more over sort of our averages. If it goes ahead, then we think our bad debts will be reduced from 30,000 to 20,000 because we think that we will accelerate some people who would put us at risk of being a bad debt. We'll also think we'll save £2,000 overall in our administration costs of chasing these people down who are now going to pay. And so we can work out from that our reduction in trade receivables is around sort of 66,138, because obviously we have our existing level. We worked that out on the daily basis of amounts that we owe to at any one time. Remember, we used that we were about 2 or 3 slides ago. So that's the number that's been taken from there. So our sales revenue times our average trade receivables period divided by 365 to give us the amount that's outstanding to us on the average every day. Now we need to reduce that because 40% of those people will now be paying us less because they're going to be getting a 5% discount and they'll be paying us within sort of 30 days. So first of all, let's work out how the change in days for us with that. So the ones that will be paying in 30 days, I think you can see that is, nope, it hasn't liked that. Right, yeah, so we calculated that, but Neil, going forward, 40% will now be paying within 30 days and 60% are going to be paying 150 days. Now, those are our estimates. You would have to do some research, think about this. And obviously, if we've got that wrong with the 40% and the 60%, then our numbers have got like no accuracy. But we'd be wrong to think everybody's going to suddenly pay us within 30 days. But 5% discount is reducing our trade receivables. So we can see that actually we'll have done a massive job. If this works and 40% of our customers now pay within 30 days, then we will take our trade receivables on any one day down to 66,138. Now, in reality, that's not going to be the amount of the saving for most businesses. That's because we've got such a high average period of 136 days anyway, and we are saying that 40% are suddenly going to get their act together and get to within 30 days. That's why we've got so much. But if we could pull that off, then we have usually reduced the amount that the business is owed on any one day. However, we've got to then also weigh up the cost of that to us, because our costs are going to be a 5% reduction on 40% of our revenues. And that here, it's only, we've got that at 14,200. We've also got some interest because we've said of our cost is 12% our finance cost. We are seeing that we have saved some interest through getting all this money through the door sooner. We've also got some bad debts reduced down to 10,000. We've saved £10,000 worth of bad debts, and we've also saved £2,000 in costs. So we can see from that we have actually got a net saving of 5,737. So it's all that, I'm going to offer 5%. I'm going to discount on people. And look, I'm going to get 40% of people taking that on board. And that's going to reduce my bad debts. It's going to give me administrative cost savings. And it's going to really reduce the amount that's owed to me at any one day. In actual fact, the financial cost of that is bigger than you would think. We effectively, overall, we're good. We've got 5,737 is our savings outweigh our actual cost. But so it's worth doing here. But the finance costs go higher, or if the take up is less than we expect, then it may tip over, whereby the cost of the discount that we give actually outweighs the financial savings that we make. Doesn't mean we still wouldn't do it, perhaps because of we're massively reducing our risk, because instead of being owed 264,000 on any one day, we now owed 66,000 on any one day. So we've, in terms of our balance, remember our balance right at the beginning was benefits versus costs and risks. Our risk is massively reduced by doing this action, but the cost savings are not as good as we might think they are. So I think you have to test both before you just throw a discount at something. And as I say, the difficulty, as you've seen, is where have I got my figures from of the amount of take up. So you might have to just do it and assess, and do like most likely outcomes, and I say monitor it and review it, and don't hesitate to take action if it's not working out the best way that you thought. Okay, so handling collection, as we've said already, let me just check on my timing. So if effective collection is going to minimize these risks, your non-payment risks, and also maximize your cash flows. But as we've said already, if you fail to collect payment, that's exactly the same as giving credit. So there's no point doing this huge exercise about 30 days credit if actually you don't bother collecting it for 60 days. Now, trawling across the sort of the industry, the ideas that are put forward for handling collection, I've listed there on the slide. The main thing that they think is this developing customer relationships. And that doesn't necessarily mean taking the CEO out to watch the rugby, but to make sure that there's a connection between the staff that are responsible for collection and the staff that's responsible for payment. I got out of it like a few years ago, but I had a furnished holiday letting business, and I was on like first name terms with the woman at the council over various things. But she knew who to ring about business rates, and I knew who to ring about business rates. And that relationship eased the way for me and the council. So it kind of is, that's where you have developing those customer relationships at that collection level. Publicising your credit terms so we don't have any arguments, we don't have any disappointments. We've talked about that already. Issuing your invoices promptly. It's like small businesses, especially when they're doing services, they sometimes see that as a drag. But you really need to, the prompter you issue the invoice, the sooner you're going to get paid. And you must rigidly follow it up with monthly statements and reminders. The thing about that is to make sure that it's accurate, because it is aggravating if businesses chase up for monies that have actually been paid, because that requires your purchaser to essentially connect with your staff to explain that they have paid. So you need to have actions, which could be stopping deliveries and/or the credit facilities if the reminders are ignored. There does have to be some consequence. It doesn't necessarily have to be sort of suing. You do need to say, right, okay, if I've sent out the invoice, I've sent out the statement, I've sent out the reminders, what do I do next? If it's all like, oh, I'm not going to do anything, your purchasers will see that and they'll think, oh yeah, I have to pay in 30 days, but they never do until it's 90 days. I'll pay at 89. And then, of course, use the ratios, use the receipt patterns and aging schedules. All an aging schedule is it shows you what invoices are outstanding at like 30 days, 60 days, 90 days. So you can really focus in on those that are, say, at the 90-day level. So reducing, so we said about credit control. The other thing that I want to sort of pick up on in the time that we've got left is reducing inventory levels. So there's ups and downs to this. So this is quite difficult to navigate. So you have got the reducing initial outlay. If we buy less stock, we don't spend as much and it's tied up on stock. It also reduces storage and handling costs for all the stock that we have. The more storage we need, we reduce our risk of pilferage. It may or may not be an issue with your client, but the more stock that's held, the chances are more people are tempted. And also it reduces the risk of obsolescence, waste, damage, etc. However, if we don't have enough stock, then that's going to compromise our future production, both in times. So just in chat, both in times of the and output. So sorry, I'm just looking at the chat box there. So if we don't have enough stock, it might take us longer to deliver on a client order. It might actually reduce the amount of client orders that we can send out. We might lose customer goodwill because we're not there to respond in a way that we want to. It might ultimately then lose sales revenue. And if we need to get things in a rush, it might increase our transport and handling costs. So this is a really fine line to walk. The credit control's a no-brainer, but a bit more. But this is a little bit, easier to get wrong. So in terms of inventory management, we need to start by identifying our optimum inventory levels, and then we'll set levels of control on that optimum inventory based on our value. We'll keep records, we'll send inventory reorder levels, and do everything that's like sort of security around it and monitor it through the operating cash cycle. ERP applications are just automatic stock management software packages. There's plenty of those around. And I just want to mention the just-in-time inventory management. If you've got really powerful relationships with your suppliers, you can keep, so an approach is to not have any inventory, but commit to them to deliver immediately as soon as you want anything. So if you're powerful, Nissan are quite famous for dealing with doing just-in-time inventory management, whereas if they want something, they have relationships with suppliers that get it to them in a couple of hours. That means they don't have to have any money tied up in inventory. But again, you've got to have a certain type of bargaining power to be able to rely on that. So I think the thing that we probably want to look at is the optimum. So the optimum is, again, it depends. You would think, oh, I wish I could give you a definitive amount, but it depends on the level of demand, your pattern of demand, your lead time, which is your time between placing an order and the receipt of the goods, and the shelf life. So if we go back to the Lazy J bakery, you're not going to want lettuce tied up in inventory. But you just there, it's all about speed of supply chain. Now we can use our financial ratios on our average inventory turnover period. Remember that was part of our operating cash cycle as a starting point. So we look at our average of our opening and closing inventories divided by our cost of our sales, times by 365 days. And then we can create an inventories budget that is linked to our cash and other budgets. So for example, if Lazy J Bakery expects to sell 500 sandwiches a week through its new delivery service by the time it's been up and running, then each day it's going to need ingredients to deliver on these. And so we would work it backwards and create an inventories budget. Now, that's it's not easy enough. That's fairly straightforward. The debate is around the buffer. So you might want to consider maintaining a buffer to avoid the risk of running out. And that does depend, obviously, on your degree of uncertainty, your cost of holding a buffer inventory, because obviously you're investing in it, and your likely costs of running out. And, you know, we saw everybody hoarding toilet rolls in the pandemic. That wasn't for a business, but it's effectively that was people creating their buffer against the risk of running out. And you know, lots of people would have had lots of money tied up in that. But if you think about it, what we're doing with a buffer is we are effectively accelerating our reorder point. So we're saying, okay, we're never going to let our items get below 10 in stock. So when they get to 10, we do the reorder point instead of ordering them when it gets down to 0. So that adds to our costs, but again, it helps against those downsides that we saw of a reduced inventory. So want to calculate a buffer. So how we might actually decide what an appropriate buffer is. I'm actually using my husband's business now. So he orders 40 sets of skateboard wheels. So they come in packs of 4, as you might expect, but each set is a pack of 4 wheels, and they come in sets of 40, and he typically sources them from the US. The supply lead times, it can be anything from 7 days to placing an order to 21 days. That's the worst it's been. On average, it is around the 2-week mark. And his daily demand varies from 1 set on average to a maximum of 4 sets, but his usual average is 2 sets. And we can get all that data from our historic sort of positions in the business. We then have to do a reorder point. Now, to be certain, so our absolute will never run out, is it if we do a reorder point that is based on the maximum usage and the lead time. So in our circumstances here, we would have 84 sets of wheels. So if Andy had 84 sets of wheels in stock, he would never run out based on those numbers. To be honest, that's quite an expensive outlay, and also is they've got to be stored. So the most, even when we look at the most likely usage, it's actually only 28 sets of wheels. So if we had a buffer that was based on the most likely usage and lead time, we'd be 56 sets of wheels. So effectively the difference between the maximum usage and lead time and the most likely lead time is our buffer. So if he had 56 sets of wheels as his reorder point, it means that he could always reorder. His risk of running out is incredibly low. So that is the that's sort of the technical buffer that we use. But of course, it's 56 sort of sets. So they come in 40 sets. But when a new order's received, we'll get that immediately following that. We've got a minimum lead time and usage is then we can take that off. So if we take this 40 at that point, plus the 84, which is the maximum, take off the minimum, this gives us 117. There's no circumstances where we should ever have more than 117 in the business. And of course, that's when the order for 40 has just come in. So you see, we've got our, we might go lower, but that is based on us saying, right, we'll never run out at 84 because that's our maximum. And if we order one and we get 40 in, we're going to end up having 124. However, at that point, we've always got this minimum. So we take that off. We should never have more than 117 sets in the business. If we have got more than 117 sets in the business, we've got too much. Our buffer's too big. We might actually go for a more realistic buffer, would be 56 with a small risk attached to that. So probably our reality is going to lie somewhere between the two. Okay, so in terms of economic models, they recognise the key costs that are associated with inventory management as being the cost of holding an inventory and the cost of acquiring them, not the acquisition cost in terms of what the inventory costs itself, but the handling and transport costs. And then it calculates the optimum size of an order that balances both elements. So we'll have seen the EOQ formula before, but here the D is the annual amount that we need expressed in units. C is the cost of placing the order, so not the unit cost, but the admin and handling. And H is the cost of holding one unit for 1 year. So here my example is No Slip Limited, and they sell 4,000 bags of sand each year. And the cost of holding one bag for a year is £4, and the costs involved in placing an order for delivery, shipping and handling is £500. Applying the EOQ, we see that we've got that gives us a result of 1,000. That means that if we sell 4,000 bags of sand a year and our EOQ model gives 1,000 bags, we should order bags of sand 4 times a year in batches of 1,000 bags in order to meet our sales demand. So rather than buying, I don't know, ordering a 250 a month or something like that, we would just do it in 4 bags. That's a very basic model, which assumes we've no fluctuation in demand, we've no buffer inventory, and we've no discounts. But again, this will be a computer program, so we can do modifications. And in reality, this is quite used often in practice. But this is all about this is about reducing sort of your transport and holding costs by not doing too many small deliveries. Okay, and in terms of controlling, I don't think we have much to say about that, just about the ABC, system of inventory control, because not all inventory is created equal. So at the Lazy J Bakery, patisserie grade chocolate is far more expensive than flour. So you're going to want to control that inventory of chocolate more. And so ABC, we effectively throw all our inventory into one of 3 categories. A being where it's relatively few in quantity, but has a large proportion of our value in the goods that we ultimately sell on, down to category C, which is numerous but of low value, like washers or screws or something. And the B is in between. And then we can sort of focus our management time on category A, because that's the one which we don't want to mess up. Does it really matter with category C if we've got like 1,000 screws instead of like 1,200 or vice versa? But we can make a real difference with A. That's that. I'm very aware of the time, but I think I can just about do it. So the third one was delaying payment to suppliers. The good side of that is we've got some interest-free borrowing, and we have improved purchasing power because we've got our cash with us for longer, and it can be more convenient for us. But the downside is that is going to cost us, because perhaps we get higher prices because we can't get cash discount. We might not have availability to credit because our suppliers are fed up of us. Might damage our reputation. People who don't pay can sometimes have a reputation of being in financial trouble when they actually are not. And these can be administrative costs because you're fending off your suppliers all the time. So this is the first time we've really seen where the delay in pay, the balance, there's far more negatives than there are positives. But I think there's a bit of a sort of balance in between, isn't there? So you've got to, again, establish a clear policy, streamline your administration around this. Your free credit, the value piece is to exploit the free credit as much as possible. So if you've got 30 days, use 30 days. But query whether you would use 60 days then, because that might push the balance into a negative one. And again, the operating cash cycle can help you here to try and get it to a reasonable amount, but you do need to be on top of that. But I think there's less to really talk about that, other than making sure that you use free credit and you don't spend an awful lot of time fending people off and damage your reputation. Okay, so let me just have a look. Okay, so the external sources of short-term finance. I'm just going to wrap up with this because I did mention it. But less for us to, it is external. So to some extent, we've got to link out to external partners to get it. So bank overdrafts, they are relatively inexpensive to arrange by comparison sort of with other sources of finance, but interest rates do tend to be higher than long-term finance, and they are repayable on demand. So, again, watch against using an overdraft as a long-term finance. Debt, and you're down to really your relationship with your bank. Debt factoring, as we've said before, this is where you pretty much get an advance of about 80% of your approved trade receivables. So what the debt factor will take on. And then as and when the debt's collected by them, they'll pass on the rest of the fees, what they've collected, and they'll take off the fee for doing that, and also interest on the 80% that they've advanced to you. Essentially, what you're doing here is you're outsourcing your debt collection, but it's at a cost. And it's not always available or suitable for small businesses because there is usually a setup cost and a minimum amount going through. And debt factoring can sometimes give impression of financial difficulties depending on the industry that you're in. But you're always like, oh, so-and-so's getting that debt collection agency to sort us out. Can be quite surprising. But in this day and age, debt factoring is quite common. As I say, for small businesses, it might not be financially viable, or they might not take you on. Invoice discounting is a little bit of a different. You borrow effectively on a proportion of the invoices that are outstanding, and you then have to repay it in 60 to 90 days. So it's kind of like a short-term loan. You stay responsible for collection yourself, and then your repayment's irrelevant. It's not dependent on success. You just have to, it's effectively it's almost like a payday loan for businesses. It is cheaper than factoring, and there is no sort of external change as far as your customers are concerned. I just wanted to mention those. Okay, so I cantered through that last bit. If there's any questions, I think there is a couple, but I'll try and deal with those. But please ask them now. I'll stay around to deal with any questions that people have got. But if you haven't got any questions, just want to say thank you for those who don't have questions. Thank you very much for joining me. Hopefully, it's given you a sort of a little bit of context around this area and answered your queries. If it hasn't, then stay and ask away. That would be great. I'd be happy to help. But thank you very much for your time today, and have a great weekend. Yeah. Let me get so.